Welcome back to Morning Trade Live. It's time to go inside out on Meta platforms. Tyler Ellegard's with us, portfolio manager for Gradient Investments. Tell me a little bit about your thoughts on Meta. Of course, we've seen a lot of spending on AI. They talk about more and more. Will it be worth it in the long run, in your opinion? Some of your thoughts.
Yeah, look, I mean, from Meta's perspective, they are starting to see the return on investment, and that's really what investors are looking for. I think this year specifically, investors didn't necessarily care too much across the board for AI companies, whether that's Microsoft, Meta, Amazon, Google, or Alphabet, sorry. I think investors didn't necessarily care what the return on investment is yet. I think that's a more 2026, 2027 type of picture. We have to get the infrastructure in place. But the fact that Meta is seeing that return on investment already through their generative ad recommendations, I think that's very important for investors in Meta and why the stock is doing what it's doing. So I think overall, Meta is going to continue to spend on it. I think that CapEx is going to continue to increase, maybe not at the same rate, but I think they will continue to increase that CapEx going forward.
When we first heard during earnings season at one point with the spending that Meta was going to do, but then it was also matched. So many of the other Mag 7 came out with these incredible numbers. At the same time, we have the super intelligence team that Mark Zuckerberg himself has been overseeing and offering some big bucks to try and poach talent. What do you think of that?
Well, from an AI perspective, we're in the generative AI phase right now. And what these companies are doing, they're not so much focused on generative AI anymore. They're trying to push AI forward to the next phase. And so that's why you're seeing Mark Zuckerberg trying to poach other talent, because they're trying to move their platform forward and be the first mover to super artificial intelligence. Or AGI, sorry, just like ChatGPT and OpenAI were the first real company to be generative AI. So whoever that first mover is really wins that phase, and that's what these companies are really spending for.
So at this point now, when you think about AI and Meta, I mean, what is the outlook overall? Is this a winner? The stock's at $714 right now.
I think it's a winner. I think Meta can continue to push forward, especially when you're seeing the revenue growth, you're seeing the earnings growth, and quite frankly, you're going to start to see more free cash flow growth. We've seen free cash flow margin compress a little bit here. And so if you look at a valuation metric of price to free cash flow versus a price to earnings is probably more in that long-term average right now, whereas price to free cash flow is actually quite expensive. But as this CapEx spend slows down, it's still going to grow, but it's going to slow down a little bit. And so you're going to start to see that free cash flow margin increase pretty dramatically. And so if you start to look at 2026 and even 2027 estimates for free cash flow for Meta, that valuation metric comes down quite a bit and actually begins to look quite attractive. So I would say the outlook is great. And then you also couple that with Meta's ability to generate revenue from ads. And now they're launching WhatsApp. So we've all seen how well they've done with Facebook, with Instagram, now Threads, and now they're launching the WhatsApp. So the amount of options they have to produce revenue, produce free cash flow is so wide that I think Meta's outlook is going to be very good, and we'd be buyers here.
Yeah, I thought I saw in your notes something about $850. That seems something that can hit.
Absolutely. I mean, it's really not that far from where we are, right? It's about 17% upside from here, maybe a little bit more today with the pullback, but $850, it's still a 30 times PE multiple. You're getting mid double digit, maybe even high teen growth for revenues, EPS, free cash flow for the next 2 or 3 years. And you have a market that's trading at 22 times. So I think the 30 times multiple on price earnings is very, very warranted at this point. So we like the company. We have it in a lot of our portfolios here, and believe in the company going forward.
And incorporating AI, the ads, you talked about that, the overall engagement trends. You said you're positive there, proving the investments are working. So overall, fan of Meta. What about the Mag 7 overall? Do you have other favorites? I mean, do you have 1 or 2 favorites in that group, Tyler?
Yeah, I mean, you have to be selective here. My favorite new Mag 7 name is Broadcom. I know that was recently added to the Mag 7 index. Broadcom is my favorite for their ASICs division, their AI revenue. The other one that I really like is Microsoft. Their Azure business is going to continue to grow. Obviously, their partnership with OpenAI is quite contentious right now, but Microsoft, the amount of users they have and the rollout they can create, I think those two would be my other two favorites for the Mag 7.
Yeah, understood. All right, Mag 8, I guess. Tyler Ellegard, Gradient Investments, thank you so much. Wonderful to see you. Now it's our chance to take a look at an example trade. Tom White, host of Fast Market, is with us. And, he was just talking about the possibility of going to $850. And in fact, you have a bullish example trade. Show us that.
Yeah, I think there's a lot of optimism in this name across the board. I've seen the analysts ahead of the earnings at the end of the month. I believe they're on the 30th. Starting to hike their price targets up near 800 based on the fact that they're expected to beat those growth rates of about 15% that we saw year over year last quarter. So, yeah, there's a lot of optimism in this name, but not surprisingly with the NASDAQ just below all-time highs. But I looked at something that kind of avoids that earnings event but takes advantage of a move higher into the report. We should probably hear some more analyst commentary as we get closer to that report over the next few weeks here. But I looked at a bullish call vertical. I'm going to buy in the July 25th weekly cycle for this example. That's 14 days to expiration. You avoid earnings. Buy the 720 strike call. It's out of the money by just over $5 to the upside. And then against it, sell the 740 strike call. $20 wide bullish call vertical here. You're going to pay roughly about a $750 debit for that. That's your risk, $750, with the opportunity to make $1,250 if it goes above 740 over the next 2 weeks. Now, you got to remember the stock was just at all-time highs of about $747 just over a week ago. So it has that ability to go up there. You've got a good risk-reward setup, but you do need, on this type of strategy, you do need the stock to move higher to above that break even of 727.50 over the next 2 weeks. That's about 2% above the current share price. So this is one of those strategies. You're taking advantage of a low volatility environment, but you do need a move to the upside to get above that break even.
Okay, and if you wanted to be more neutral and don't need to have that move, let's see something that is a more example trade of a neutral trade.
Yeah, it's still directionally bullish, but it's neutral to bullish, right? So you're giving yourself a better probability of success on this example that we're going to look at here. If the stock's trading around 715, I believe right now, maybe about $711 right now, but selling an out of the money put vertical, using that same July 25th weekly cycle that expires in 2 weeks, we'll sell the 700 strike put. And then against it, to make it risk defying in case the market goes down, Meta's not immune to market moves. Sell the 700 put, buy the 680 strike put. So a short, neutral to bullish, $20 wide put vertical. You're going to collect roughly about a $450 credit. You're probably going to collect more like $550 right now because the stock has pulled back. But if you collect that $4.50 credit, that's what you can make on this trade, $450 per spread with about $1,550 in risk. The key is it takes your break even all the way down to $695.50, right? So you're giving yourself nearly a 2.5% cushion to the downside on this one. Now, the probability that that short 700 strike in this strategy finishes out of the money, it's just nearly 50 or 65%. So the higher probability of success for this trade kind of skews the risk reward more to the risk, right? You've got nearly $1,500 or $1,600 in risk on this one, but that's because you can profit in 3 out of 4 scenarios. The stock can go up, it can stay where it is, or go lower but remain above that 695.50 break even, and you can be profitable on this type of trade. So they're both directionally bullish, these example trades. One's just a little bit more conservative in case the stock does pull back, where you can still remain, you can be wrong and still remain profitable on the short put vertical.
Hey, I like being, you could have a win in 3 of the 4 scenarios, right? That's a good setup. Thank you so much, Tom White.
Thanks.
Great to see you looking at Meta today with his example.